let's get started. So thank you everyone for joining us today on our April webinar. We're going to be covering the fun topic of investing and specifically timeless truths for investing. And so I have the pleasure of hosting my friend Jacob at Eventide. We've been hanging out with Jacob for many years now. Shared a lot of good barbecue together, a lot of good conversations, and just really appreciate his help to sound stewardship and just his partnership, and always encourages us to continue to ask good questions around investing. And so we hope we'll have good questions today. And so as questions come up, feel free to use the Q&A option there at the bottom of the screen. We'll have some time at the end to address those questions there. So Jacob, thank you so much for taking time out of your day to talk with us.
Derek, thank you for the warm introduction. Everyone that's joining, thank you so much. It's a pleasure to be with you. Like Derek had mentioned, I'm with a company called Eventide Asset Management, and we're based out of Boston. We're an investment company. I'm hoping to share timeless truths for investing. And this is not a presentation, just so you know, where I have some secret formula or I'm going to reveal something that you haven't heard before. That would not be timeless. I'm hoping to reinforce what the Sound Stewardship team has been communicating with you all since you began engaging with them. Because on the path to building confidence and contentment, you have to be rooted in timeless truths. And so I'm excited to share maybe some reminders with you today on this journey. So a few things that I'd like to set up kind of as the backdrop and why I believe this is very relevant for 2024 is think about the headlines that we're having to contend with today. Runaway inflation that's been affecting all of our pocketbooks over the last several years. Another contentious election that we keep hearing about makes me want to turn off the news, not turn it on. What about different market-moving geopolitical risks? We have an ongoing crisis within Ukraine. We have the threat of a Mideast crisis as there's tension in Israel and in Gaza. We always have the looming threat of China and the geopolitical risk there as the world's second largest economy. What do we make of this? So the headlines may look different, but our behaviors rarely change. And so my hope today is that we can really think closely at these timeless truths, hopefully sharing some wisdom with you so we can all become better investors. And so I feel like a good place to start is looking at a few headlines. This is back a few years ago, and I think it's a good representation of things that we hear today. Excuse me. So what we're looking at here is a magazine that some of you may be familiar with. It's a financial publication called Barron's, and they're very famous for their headlines and periodicals here. In January of 2020, I like this headline, "The Method Behind the Melt Up, Why the Dow Won't Stop at 30,000. So you can see this optimistic tone to start the year. Nothing could go wrong. We were feeling very bullish about the outlook of the market, and that upward momentum should continue. But what we were unaware of was the impact of COVID just a few months later. So the March headline, strikingly different. What Washington needs to do right now to spare America a second Great Depression. How ominous. And I think it just speaks to or spoke to the uncertainty of living through that time. I knew it well. I became a new dad in February of 2022. And so I was already preparing to be somewhat stuck at home. And I tried to come back to work that March, and they said, nope, take your laptop home. We're just going to kind of wait this out. And it was a different world then. And so I can relate to this uncertainty in a very real way. Now, March 23rd, that actually happened to be near the bottom of the COVID lows during 2022. But there was still a lot of skepticism in the market. So the headline the following month was, anything could cause the next pandemic. How reassuring. How reassuring that there's just another panic lurking around. Now, you may recall that at this point, even a month later, the market started rallying and momentum was picking up steam, but very few believed in it. And so the market commentators of that day went with this headline, that there were so many risks and where was the next shoe to drop. Well, it turned out that the year finished up positively, and there was a lot of momentum in the market, a lot more headlines, but I think the one in December is specifically striking. The S&P could gain another 10% next year. It's interesting. I'm beginning to see a trend here, friends, that these headlines, they're rarely changing, but the messaging doesn't change. Optimism, bullishness, heading into the new year, even though that we've been fraught with uncertainty. Think about the headlines and the stories that I mentioned earlier for 2024. We're having to wrestle with this again this year. So how should we think about investing in the market under this backdrop? Is now a good time to invest? What do I invest in? Do I take money kind of in the market and put it in cash now that I'm able to get an interest rate on cash finally? How do I make these decisions? Well, rarely should they be made in a vacuum. And our belief is that if we can really be grounded in timeless truths, we'll find that confidence and contentment that we're looking for. So I've got 5 things to unpack with you. And again, they should not be the first time that you've heard about these different concepts, but I think reinforcing them will make us more astute and successful investors. So I'll read these with you. Keep your eye on the owner, not the dog. Restrain yourself. Employ a system that forces you to buy low. Remember the most powerful force in the universe. And invest in businesses, not markets. So we'll go through each of these one by one, and hopefully you'll be able to connect with them in a very personal way. So keep your eye on the owner, not the dog. What in the world could Jacob be talking about here? Well, let's start with this famous quote from Ralph Wanger. He is a storied investor, and he was describing market participants and activity and our relationship with kind of watching the headlines here. So I'm going to read this quote. I think it is insightful, and hopefully you can pick up on the analogy here. He likens the market to an excitable dog on a very long leash in New York City, darting randomly in every direction. The dog's owner is walking from Columbus Circle through Central Park all the way to the Met. At any one moment, there is no predicting which way the pooch will lurch. But in the long run, you know that he's heading northeast at an average speed of 3 miles an hour. What is astonishing is that almost all market players, big and small, seem to have their eye on the dog and not the owner. Are you all seeing the analogy here? I'm a visual person, so maybe we can get straight into the point, and this will help connect the dots. So what we're looking at here is a graph of the historical returns of the S&P 500, and that is just a proxy for the 500 largest companies in the US. It's generally considered a good proxy for the US stock market. So if we go back 150 years, you can see the blue line is actually the annual price movements of the S&P 500 index. It's kind of bouncing around. That's the dog. It's moving around in every which direction. It goes up, it goes down, it goes sideways. The yellow line is the owner in this analogy, where it is moving at a pretty consistent pace of about 7% after inflation growth over the last 150 years. So you can be confident in knowing that directionally markets move up and to the right where we want them to. And so if we're so laser focused on the market gyrations of the short term, we tend to miss the bigger picture, which is the patience is rewarded when investing in the markets. And it's incumbent upon us to keep our eyes on the owner and not the dog in this scenario. Number two, restrain yourself. Now, this may seem personal, and it is. It certainly is for me. I have to constantly become aware of my own behavioral biases when it comes to investing. So even though I work in the industry like Derek and the Sound Stewardship team, I, like others, are not immune from these behavioral biases that we have to overcome. So we can start here. For those that read the Wall Street Journal, you may have seen these articles. They're published at the end of each year. And really, these articles is more of a coronation ceremony for the king of mutual funds, king of investments. And so what the Wall Street Journal does is they look back at the last decade and they select what was the top performing managed investment or mutual fund over the prior 10-year period. And so you can see in 2009, the CGM Focus Fund was highlighted. Now, we know them well. This is no longer a fund that you can invest in today, and we'll get to why. But we know them well because this company is actually in the same building as Eventide in Boston, ironically. So the CGM Focus Fund, and you see this circled here, it rose more than 18% annually and outpaced its closest rival by more than 3 percentage points. Now, this is incredibly powerful because if you actually look at that decade of time from December of 1999 to December of 2009, the market actually lost more than 20% cumulatively over that period. So to have a fund rise 18% annually is absolutely impressive. Well, how do you think investors did? Investors in that fund specifically. And I'll give you a second to think about it because it may surprise you. You think investors did better than that fund on a performance basis, worse? By how much? You may be surprised to hear that investors weren't around to enjoy much of those gains. The typical shareholder lost 11% on average annually in that 10-year period. Well, how could that be possible? How could you have been fortunate enough to invest with the greatest managed investment over that time period, but lost money? Well, this is why we have to restrain ourselves. It's because we have the tendency to chase performance and buy a fund after it's had a strong run or strong run up in performance. And we sell at the worst times. I'm guilty of it. I won't point fingers, but probably many of us on this call are guilty of that too. And that's how investors performed worse than the professional managers in that fund. Something to think about. Now, we lost a real titan of industry this year with the passing of Daniel Kahneman. He's a Nobel laureate, an economist. He wrote a book, Thinking Fast and Slow, and I highly recommend this. The premise of the book is that it's easier to recognize other people's mistakes than our own. So true. When I think of the CGM focused investors, we may think, those foolish people, that wouldn't be me. I invest in my 401k. I'm listening to Derek. I'm listening to Matt and the team. That would not be me. I think that we need a wake-up call here. I believe, and I think the numbers would suggest, that we are our own worst enemy. This is a study that looks at the last 2 decades. It's a study from JP Morgan, the Dalbar study. And what they're attempting to do here is identify different asset classes, which simply mean different categories of investments that people are invested in. And how did they perform annually going back and looking at that period? So it's not predictive. We can't obviously predict the future, but I do think that there's some insights here. So when you look at this 20-year period ending in 2019, you saw that real estate was actually the top performing asset class, over 11% returns. The S&P 500, over 6%. So similar to that long-term average that you may recall. You have balanced and moderate portfolios hovering around 5.5%. The equity in our homes rising on average of 3.4%. This caught my attention. Inflation at 2.2%. If we updated this chart, that number would obviously be higher. I know it doesn't feel like that today. But, well, wait a minute. Before I get too far along, what about this orange bar chart here? The average investor, 2.5%. Oh my goodness. How did the average investor perform half as well as a balanced portfolio? And it's, friends, it's because we're our own worst enemy. This is that behavioral component to investing where we have to restrain ourselves. Morgan Housel, I love this quote, and I'll recommend one of his books later. He says that finance would be better if it were taught by the psychology and history departments at universities instead of the business schools. So true. I could not agree more. And a follow-on quote from Charlie Munger, who's Warren Buffett's right-hand man. The big money is not in the buying and selling, but in the waiting. So patience is key. Patience is what is rewarded, and the ability for us to restrain ourselves and fight against these impulses to sabotage our investment strategy. So we just talked about a way where we have the tendency to buy high and sell low. I want to be able to share with you a system that forces you to buy low. And that is the third truth that we think can be really impactful in putting together a successful financial plan. So try to visualize this with me here, an experiment where, let's suppose we're dropped into any point in history between 1920 and 1979. And we have to invest in the US stock market for the next 40 years. So we're committed for the long term. Now you have 2 investment strategies that you can choose from. The first is fairly straightforward. You invest $100 a month consistently for 40 years. Fair enough. Many of us are in the habit of doing this. Now, to make things fun, option number 2 is that we save that money in cash, $100 a month, the same amount of money, but we buy the dips in the market. And with this option, I'll even do you one better. I will grant you perfect knowledge of the future so that you always end up buying the dips in the market during the absolute bottoms. Seems like a pretty neat deal. Where do you think you would choose? Option number 1, investing in the same amount consistently over the next 40 years, saving that money and timing the market. Well, thankfully, we don't have to have a hypothetical experiment. Someone actually did the data for us, and we can see the outcomes here. It is a little bit of a busy chart, but I'll tell you how to read it. The dotted line is kind of this point where everything above that line, those were periods where timing the market would have performed better. And when we're below that line, when the blue line is below the dotted line, those are periods of time where consistent investing each month would have outperformed. And so thinking about that just from a percentage basis, 70% of those 40-year periods, monthly investment outperforms, which is wild to think about, but conceptually, maybe it makes sense. So when you think about this, of course, timing the market would have outperformed if in the 1920s we were just saving up our cash, and then when the Great Recession hit, that's whenever we pulled the trigger and invested at the perfect time. But those gains and the benefit from timing that event only lasted so long. And what we all know is that timing the market hardly consistent. In fact, if I took away that perfect knowledge advantage and you mistimed buying those dips only by 2 months, the monthly investment outperformed 97% of the time. It's a virtual certainty that a consistent investment program outperforms our perceived ability to time the market with any degree of consistency. But how can this be? Well, it is not a form of sorcery or secret tool for the billionaire class. My friends, this is dollar cost averaging. This is something we can all participate in. And some of us are doing it if we're regularly investing in our retirement accounts and investment accounts. What dollar cost averaging means, it's the practice of investing a fixed amount of money at regular intervals of time. It could be monthly, quarterly, annually. For example, $100 a month. So by investing this fixed amount of money, it actually buys more shares of an investment when prices fall, and less shares of that investment when prices rise. So if we look back at that lost decade of investing, when we think about the CGM Focus Fund, that was during a period where the S&P 500's return was negative. Certainly the worst 10-year period in my lifetime, negative 24.1% over that period. Well, for those that invested a fixed amount of money each month, buying more shares during those recessionary periods when the market pulled back, and fewer shares into the S&P 500 when you saw price gains, how did that strategy perform over this 10-year period? Well, you may be surprised that returns were 5.9% positive over that period of time. That's remarkable. And so you can see that this is almost a buy the dips strategy in disguise, because you are forcing yourself, you're employing a system to where you force yourself to buy low. You're just taking the guesswork out of it to where you're not market timing, but you're participating in the market by consistently allocating capital into an investment, irrespective of where it's trading at that day or that month or that year. History tells us, and this data and these reports really reinforce it, that you can be well served by forcing yourself to buy it into a system that forces you to buy low. Now, I like this quote from Napoleon here. The man who can do the average thing when all of those around him are going crazy, that is the true definition of genius. With dollar cost averaging, it may not turn any heads at a dinner party. You may not win anybody over, but it is absolutely one of the secrets to becoming an everyday millionaire. And I think that it is a tendency that's often overlooked and undervalued, and something I'd certainly consider as a timeless truth. Now, this next truth, number 4, goes along with that. So we're called to remember the most powerful force in the universe. Well, we should probably consult our beloved scientist and physicist, Albert Einstein. He believes that compound interest is that force. And so let's personalize that a little bit. So I am an unabashed, unashamed coffee drinker. So this is my coffee mug. I've probably had 3 cups of coffee today. Hopefully there are other coffee drinkers or tea drinkers on the call here. So let's just use this as an example. I think about the national average for a cup of coffee at my local Starbucks is about $3 a cup. So let's say that we made coffee at home and invested that $3 a day each month. After 40 years, what do you think that would generate in terms of a dollar return? So let's go back in time and remember that we get about 6.5% to 7% inflation adjusted returns in the stock market. So what do we think that cup of coffee would be worth 40 years later? 50,000, maybe 100,000. The answer actually may surprise you. It's nearly $216,000. That was pretty remarkable to me. And really the truth is that is the power of compound interest at work. Benjamin Franklin said with respect to compound interest that money makes money, and money that makes money makes money. Pretty neat concept. Let's break it down because I think it's helpful for us to see the math here. So $3 a day on coffee each year, it's approximately $1,095. And if we were to invest that annually at that constant growth rate of 6.7%, after 1 year, we'll have $1,168 and some change. Well, the next year, we invest another $1,095. It's added to what we already have, and that number grows together by 6.7%. So we're left with over $2,400, and so on and so on. The process repeats itself. You may not see much traction in the early years, but as time goes on, the power of compounding is realized. That's why those of us on the call that when we think about this in an investing context and you are at or near retirement, you can pay a lot more attention to your 401k balance and your investment accounts the closer you get to retirement, because you see the power of compounding over time. If we were to use the same illustration, but look at investing in an individual retirement account or an IRA, we can see where those numbers take us. $6,000 a year, $500 a month invested in a Roth IRA or a traditional IRA over a 40-year period would net you almost $1.2 million at the end of that period. It's quite the nest egg. That's how a coffee habit can turn into $1 million idea. It requires discipline, focus, and consistency. And of course, time, as the Rolling Stones would say, time is on my side. I love this quote from Warren Buffett. The stock market is a device that transfers money from the impatient to the patient. How true. How true. So we're rounding the corner here. This is the 5th of our 5 timeless truths. And I believe it's one of the most important. Invest in businesses, not markets. So our belief at Eventide is that many of us have lost sight of the true purpose of investing. You see, we've been divorced of its original and most basic purpose, which is supplying capital to businesses. We're rooting for the success of these businesses because we're allocating capital to them. And in return, we get dividends and appreciation and the like. Well, instead, that's really been sanitized to just, well, we're here to invest for profit and we're just investing in the market. So we follow the S&P 500 or the Dow or other different indicators and indices on our smartphones now. But we've become disconnected from the actual businesses that we're investing in and profiting from. And it's problematic because what that does is it enables us to have a mere performance-based relationship with our money, right? So when the stock market is up, we may seem elated or positive. And when it's down, we have the opposite behaviors. And I think that really bleeds into and feeds those behavioral biases that we've discussed previously. So how can we describe and hopefully change our relationship with investing? I think this quote from William Cavanaugh, who's a professor at DePaul University, I think sums it up very well. Retirement accounts tend to just go into mutual funds, where not only do I not have any idea of how these companies that I have stock in are being operated, I also don't even know what companies I have stock in. And they're run by an elite group of managers whose one preoccupation is with increasing the bottom line. So that tension between not knowing what I own, not knowing what I'm investing in, and that profit by all costs motive. I think that's a very real tension. Now, there are some in our industry who are unconcerned with what it is that we own and are profiting from. I was at this investment conference in 2016 where I actually heard Cliff Asness, who's a famous portfolio manager, say boldly and proudly, I pride myself on not knowing what's in our portfolios. You see, Cliff is a numbers guy. His value proposition is in not knowing the stocks that are in his portfolios because he wants to be very rules-based and making decisions free of being connected to the underlying companies. Our view at Eventide is the exact opposite. We believe that investing is ownership, that as shareholders, we're allocating our money to companies. And in return, we receive profits and growth and income. But we also believe that there's an ethical responsibility because we're profiting from all of the activities of those companies, both positive and negative. And so, because we believe that investing is ownership, the first and most basic questions of investing should be ownership questions. And so we ask ourselves, when we look at investing in a company, how would we engage a management team on a number of these different issues? We're very, very concerned with how a company interacts and hopefully adds value to these business stakeholders. So we ask ourselves questions like, how are customers treated by this business? Are they raving fans or are they detractors? What about employees? Have you looked at the Glassdoor reviews on that business? What's their labor turnover looking like? Because that can certainly impact the bottom line. What about relationships to suppliers? A broken supply chain is not great for anyone. What about relationships that business has to the communities where they're operated in? That's important. You want a business to be a community partner, not a community pariah. The environment is an important stakeholder as well. You want to make sure that companies that you're investing in aren't tied up in litigation and are practicing positive environmental stewardship. And what about a company's benefit to society? Is that company trying to come up with a cure for cancer or another flavor of toothpaste? You can try to quantify that value. Our belief is that by holistically understanding businesses that we invest in, we're practicing ownership. So we ask these type of questions. Would we want to work under the leadership team of that company? Would you want your son or daughter having a summer internship at this company? If you walked into a supply center or warehouse, would you be proud of the quality of those working conditions? Does the company's environmental policy and actions leave a better planet for our grandchildren? These are all relevant questions to ask, and something that I would encourage us all to think through as we begin to ask ownership questions. I'll read one quote as we round the corner and wrap up here. This is from our Chief Investment Officer and founder of Eventide, Dr. Finney Curavilla. Many people have had the experience of purchasing a stock, becoming nervous as it declined, and then selling out at a loss, perhaps only to see it go right back up. I've been there. On the other hand, if a person knows the business that the stock represents, trusts management, and so comes to believe in the company that these declines are not so troubling, that person is a confident investor, because history has shown that great businesses not only endure economic downturns, but emerge even stronger, making these declines an attractive point to invest further. When you understand the merits of these companies in which you invest and better appreciate what you own, you can transcend a mere chart-based financial relationship in investing. You can then have greater confidence and less stress because you are not buying mere paper, but quality businesses that you know and trust. After all, life should not be spent staring at a computer screen, watching ticker gyrations, but instead free from needless stress. I have to agree with Finney here, and I am guilty of succumbing to these behavioral biases, but my hope is that these 5 timeless truths can educate, motivate, and inspire better outcomes for all of us. I'll read these 5 again, and then I'll throw it back to Derek for some Q&A. Keep your eye on the owner, not the dog. Restrain yourself. Employ a system that forces you to buy low. Remember the most powerful force in the universe, and invest in businesses, not markets. This is investing that makes you personally rejoice. That's our belief. I just want to thank you all for attending today. And Derek, I think we have some time for some questions, and I'm happy to stay on and have some back and forth with you. But thank you for allowing me to share those formal remarks, and I hope that it's been an encouragement to us all.
Yes, that was great. Yeah, thank you for those helpful reminders around those timeless truths there. And so I was really enjoyed that and soaking that in there. So yeah, we do have time for some questions. One thing, and you kind of touched on this towards the end there with Finney's quote around stress, but how do you balance the tension of having awareness? I'm not living under a rock, but of what's going on in the markets, versus like canceling out the noise and just kind of plowing through, and I don't care what the headlines say or whatnot. Like, how do you kind of wrestle with that?
Yeah, Derek, it's hard to do it alone. I think we have so many, like you said, noises in our ears. If you turn on CNBC or read the financial publications, you get those headlines. They have an incentive to sell ad space. They have an incentive to draw you in as a consumer. The goal is not necessarily to educate, and it's
Right.
certainly not to partner with you on your financial journey. So I think the number one is to have a guide in your corner, a financial advisor who's competent and committed to your success and your family's success, because everyone's attitude toward money is different. I know in my family, my wife and I have different communication styles and thoughts around money. And so having a guide that can really solicit our feedback and understand our family goals really helps us navigate these times. So whenever I hear these headlines, because they're unavoidable,
Right.
I can just kind of rest a little easier knowing I've got someone who's in my corner that can stop me from making poor decisions.
Yeah. Yeah, it's so true. There's, a lot of research around, especially around financial therapy, of like seeing the stock tickers and, is it a green day in the market? Is it a red day? Like that stuff just adds more stress to it. And so it's out there. It's hard to avoid it. But yeah, I like what you say there, is like having someone to kind of help interpret or be the buffer of like, okay, yeah, that's a thing, but that's not. Remember what we talked about over here. This is your plan, and this is what we said we're going to do in light of all these other things. So controlling what you can control and kind of staying the course, and just having that person to come alongside and reset along the way there. And so one thing we were talking before we hopped on the webinar was, that Barron's, those Barron's articles happen throughout the year, but that even happens throughout the day. When you look at there's a day back, I don't know, within the last 3 years, that Yahoo Finance had an article on there. Headline was, oh, markets are down because of this. 3 hours later, oh, markets are up because of this. Same picture, just tweak the headline a little bit. So it's like, you got to realize what that is there for. It's clicks. It's not to necessarily educate and help. It's just it's a thing there. So that's good. And kind of along those lines, though, is like, how can one distinguish between timeless investment truths and kind of passing trends? What would you say to that?
Yeah, well, I think we all have to fall back on what is proven to work. So I think something to be timeless, it needs to be verified. One anecdote I would share with you is, and I read it in a book that I highly recommend. It is called The Psychology of Money, Morgan Housel, whom we quoted in this presentation. And in that book, he does a profile on Warren Buffett, whom is a legendary investor, someone that I think many of us will know. And his point was that because Warren Buffett purchased his first stock at the age of, I think, 12 or 13, and got started early, and his money was able to compound over time, that's the only reason why we know who he is. That if he just started 10 years later, he would not be a multi-billionaire. He'd be a mere millionaire. This is still wealthy, but not someone who can speak with authority in the same way that he does now. So that's one area that I think is absolutely timeless, is just making sure that you use time on your side. And it's just one area that, hey, that can be validated through experience, not just one person's opinion. So
right.
Interesting that keeps me accountable.
Yeah, definitely. Last question here. So if listeners could do one thing from our talk today, what would you recommend?
So I'll answer in two ways, because we may have some younger investors who are on the journey, and those that may be a little older. So for those that are younger and are professionals in the workforce, where retirement is not the next checkpoint, maybe there are other goals that you have prior to your retirement. One thing that I would encourage you to do is to just keep buying. There is a book by the same title, Just Keep Buying, by an author, Nick Majuli. So he's the one that actually did that study that we had referenced, where, hey, invest any 40-year period from 1929 to 1979. So he's an author that referenced that study, his book, Just Keep Buying, is a reminder to not only stay invested, but stay investing, because you have time on your side to build wealth. And that wealth that you can generate will build confidence and contentment. If you don't have another 20, 30 years ahead of you working professionally and contributing, I think the biggest piece of advice would be to do nothing, to not react, but to focus on working with a sound stewardship guide and really reassessing your financial plan more regularly. Because the closer you are to retirement, or if you're in retirement, there are many more outcomes that can derail you. And many of those things that derail you are self-inflicted wounds. And so, I would say contribute regularly and keep buying if you're young, and really do nothing alone and work with a guide if you are close to retirement and you know that your financial security and independence is really riding on the decisions that you make. You're not alone in the journey, and I just love the sound stewardship lingo of contentment and confidence. I think they're inextricably linked, and knowing that you don't have to go through retirement alone, that you have a guide and a helper with you is, I think, critical.
Yes. Couldn't have said it better. So awesome. Well, thank you, Jacob, so much for taking some time out of your day to talk about these timeless truths and just kind of reinforce time in the market is better than timing the market, and just stay the course, have a plan, have a guide. Those are all great things that we constantly need to remind ourselves as we get out there amongst the noise. It's good to kind of recenter and reset there. So appreciate that. So thank you guys for joining us on the webinar today. We'll have a follow-up email with some resources there, and look forward to seeing you guys next month. Take care. Bye.